Hi there. Thank you for joining us today as we're filing in. I'm going to do a little bit of housekeeping for our webinar today. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We are thrilled to bring you this educational presentation. I want to say this is one in a series of webinars that we've done for pilots, and we're excited to bring you this content today. Attendees are muted, but we do encourage you to ask questions using the chat box, and the presenter will answer those queries during our question and answer period at the end of the webinar today. If you ask a question in the chat box, go ahead and leave your phone number and email contact as well. That way, if we can't get to your question, we can make sure someone reaches out to you after today's event to address that. We want this experience to be as educational as possible, so please don't hesitate to reach out and ask for clarification or expansion of the material. That is what we're here for today. I'd love to introduce you to today's guests. Our moderator today is Mark Seether. He's a partner and wealth manager with Kingsview Partners in Knoxville, Tennessee. He has a Bachelor of Arts in Economics from San Diego State University and began working as a financial advisor for Northwestern Mutual in La Jolla. Mark enjoyed finding innovative solutions to clients' complex problems, and his desire to work with the entrepreneurial minded helped him thrive as a financial advisor. Mark honed his skills as an advisor and planner. He looked for a platform that would better pair with his desire to work with clients needing to do advanced planning and specialized fixes. He found his spot back in Northern California in early 2017 when he joined Trust CFO and assisted in integrating complex tax and estate planning with wealth and investment management. Since then, he has collaborated with Josh Saunders, a retired Navy and current Southwest pilot, to build Kingsview Partners. Together, they assist individuals on wealth management and tax strategies, specializing in the specific needs of pilots. And Mark, why don't you come off of mute and just say hello so people can see your face. This is our moderator here, Mark.
Hey everyone, happy to be here. This is an exciting topic. Again, my business partner is a pilot himself, and these are just diving into some of the things that Josh has done, as well as we've had some other pilot clients look into. So when people want to build out their wealth outside of the traditional planning, the key is always, you got to get educated first. And John's going to bring some good education today.
Very good. Well, thanks for that segue. Let me tell you a little about our presenter today. John Rubino is the COO, founder, and co-managing partner of JID Investments. JIDI is a real estate, private money, and equity investment firm, which seeks to secure high yield returns with medium risk by providing investment capital to individuals and businesses with viable residential, commercial, and mixed use real estate business and/or investment opportunities. JIDI has over 20.9 million invested on 8 executing projects, 3 in Washington, DC, 1 in Frederick, Maryland, and 1 in Richmond, Virginia, and 3 in Atlanta. John is a graduate of New York Maritime College and holds a third mate's license in the U.S. Merchant Marine. After graduation, he received a commission as a U.S. naval officer. He served honorably as a naval aviator for 20 years, and in 2008, he received his Master of Science from Embry-Riddle Aeronautical University. John, I'm going to go ahead and turn the time over to you, and we're excited to hear what you have to say today.
Thank you, Marche. It's an honor to be on with you and the listeners here on Vice Chaser. It's also great to be back with my friend and colleague, Mark Seiler. We got together a few months back and had a really great podcast together with his partner, Josh Saunders. And Josh and I actually know each other from pilot training as well as being instructors down in Corpus Christi, Texas. And it was great to catch up with him again as well. So small world we're in, and we enjoyed that. It's great to be here and share my experiences inside of real estate, how I got started, and just overall why I enjoy this so much. It's just a wonderful way to share information, share my experiences, both inside of real estate, along with my kind of journey through the first chapter of my life as a naval pilot, and then now as a business owner and the COO of a business that is just doing great by the blessings of the Lord and having fun. So just a little background, I did serve for 20 years. I came out of college and went through aviation training, had my first operational tour in Jacksonville, Florida, followed that up with a tour in Southern Maryland between 2003 and 2006. And that's where I really started to get into real estate about halfway through my career. I found that the new construction home building industry was really interesting. And so I kind of ventured off and tried that out and had some really nice success. And at that point, I decided that, hey, I want to continue on with the Navy, but I still want to stay involved in real estate. So what can I do to take, some of the things that I had earned through my hard work and my investments into staying into real estate? And, in the Navy, you got some great friends and good people that, I have a great family. And I found this really unique industry called passive real estate investment, which today the industry term is called syndication. And I didn't know it was syndication at the time, but what I decided to do is I decided to partner with my very close friends, mentors, and folks that decided to end their time in the military and pursue their dream and goals of starting a business a little earlier than my dream was to continue my time in the Navy. So I decided to passively invest with these folks, get them started. And over a course of about 7 years, I had some fantastic success investing passively in opportunities that were open for investment. Condo conversions, new construction development. And I started to learn about how to analyze and assess and look at different deals from the mindset of how the sponsor or the developer or the person that is in charge actively on these projects, and really looking at what they're looking at from the top down, and also having insights and having a seat at the table to really get what they were doing, which was so exciting. And so over that 7 years, I kind of got a crash course and got another master's degree in real estate investing, and also made some fantastic returns on my money. And so that happened for about a 7-year period. Again, getting these projects, going through them, learning about the different markets across the country that were seeing things, demographics, and why these in these markets were so prime and really ripe for investment. So I took a lot of that expertise. I moved back with my family after an overseas tour in Naples, Italy for 3 years, which was fantastic. I was an instructor pilot in Corpus Christi, Texas for 2.5 years, again, where I ran into Josh. And then after those 2.5 years, I moved back to Washington, D.C., and I was working right outside the Pentagon for the Navy headquarters staff, knowing in about 3 to 5 years I was going to be retiring. And at that point, I thought to myself, okay, do I want to go out and be a government contractor? Do I want to get into corporate America? Or, hey, this great thing that I learned over the last 7 years, could this be something I turn into a business? And so that's what I pursued. And I had that 3 to 5 year period to really test it out while I was still serving, and on my off time, and when I was finished with my normal duties with the Navy, get into this some more. At the time, I was blessed with a fantastic CPA who's now my closest friend and my business partner in the business. And I pitched him this idea, and he loved it. So for a full year, he and I sat down, we put this business together, predicated again on the mindset of taking passive capital and investing in real estate projects with folks that needed private money or equity for their projects. And for a full year, we got our documentation together. We went through the legal process of starting the business and growing our team to make sure that this was done right before we launched it. And in 2013, we launched the business and we started to participate in active investments as a passive real estate lender and as a passive real estate partner on these projects. And so the things that I've learned, during my time in the Navy, the 7 years of investing, and now as a business owner for 8-9 years, it's just been outstanding and a true blessing. And so to take that and share it with the listeners, I'm going to do my best to do it as quickly as possible, but at the same time, I want to encourage folks to ask questions. If we go over something you're not sure about, please let us know. But this is really designed to provide you some education, some insights, and a good understanding of how this works, because Mark can also attest to this. This is really unique and it's exciting, and it also offers you as a individual to invest in real estate and be part of some amazing projects, amazing opportunities, and be part owners in that without having to deal with the way we do it, the day-to-day operations, the on-scene operational requirements and managements of the projects, and also, again, being able to see your money grow in these alternative type investments outside of what the stock market offers. So again, what you're going to see in syndication is you're going to see groups of developers or sponsors across America that have these amazing projects, whether they're in residential, and we'll get to some of these in a minute. You can leave this slide up, Marche, but we'll get to the details in a minute. But they have these projects in residential multifamily development, value add development or value add investment, opportunity zone, senior assisted living, student housing, some of the things that you may see on television, a shopping center that's being developed. These folks have a need for what's called private money or equity. They're going to go out to the bank. They're going to probably get 75% or 80% of the larger amount of money that's needed, but they're still going to go out and need to raise private money through institutional investment equity firms, private equity money firms, IPOs or REITs, real estate investment trusts. And that's where you as an individual can get involved and invest either through your discretionary funds or post-tax dollars, deferred gains, using a self-directed IRA, standing up a business and investing as a business. So these are just some of the unique ways that you can be involved and participate. And it's a really amazing way to diversify and be part of some amazing projects. These sponsors are going to be folks that are in different markets all over the country. They're going to locate the deals for you. They're going to go ahead and give you the information. The ways you can meet them is publicly online through research. You can go to a crowdfunding or a crowd placement website to invest on a platform. But these sponsors are going to be the ones that you're going to work with as the direct sourced investor to help them with their projects. The way we do it passively is we do the partnership with the sponsor. We do a lot of that heavy lifting to make those relationship buildings and those foundational buildings with the sponsor. And then we take those projects for review to then bring to our investors in the business. So we still do that syndication, but again, from the mindset of the way I did it for 7 years as a passive investor, to be free and clear of a lot of the risks that the day-to-day sponsors have to deal with. So you as an investor are going to be providing the funds. You're going to be involved in the project. You're going to have day-to-day visibility on how those things are progressing, and you're going to have a lot of fun. So with that, we'll go with the next slide. So I mentioned a couple of the different types of projects that you can invest in. We also refer to them in the industry standard as asset classes, and those can range from residential multifamily, value add, like we mentioned, a development project that has to go through what's called entitlement or zoning to get approved to be able to build whatever the sponsor wants to put on that site. It goes through a new permitting process. It gets the approvals for the building. And then as you can see on the screen, you may be involved in a really cool new construction project that when you go and visit the site, initially could just be some dirt, but in 2 to 3 to 4 years, you can see this amazing growing project that is finished and that you were part of and that your money was investing in. So not only do you get to see your returns grow, but you also get the opportunity to see something amazing that gets brought into a community or into a new market to help folks that need housing or need retail space for new products that they want to sell through their business. So it's really exciting. We also have other asset classes that are in demand today, like senior assisted living for our baby boomers who are retiring. They need a place to live. And a lot of them now are investing early on, and they have invested early on in policies that allow them to invest, or not to invest, to have the ability to utilize insurances to live in senior living facilities. We have a need for student housing across the country. Universities need increased housing because enrollments are increasing. New colleges are forming, and they need housing for their students. And today, I'm sure that a lot of folks who are reading the news and seeing things are seeing a massive undersupply of product on the market. There's not enough housing right now. So developers are really taking advantage of those that know the markets that they're in to expand and grow a much needed asset in their portfolios to grow housing in these markets that are depleted. So that's just some examples of those different types of asset classes that you could participate in. So some questions that folks may ask is, why should I invest now in real estate? COVID really made things difficult over the last 2 years. Residential real estate actually did very well, but office, commercial, retail definitely struggled a bit. But if you go on to Yahoo or you go on to your favorite site to watch the stock market, volatility is just, expanding day by day. Stock market is down 300 or 400 points. The day before yesterday it was up 300 points. So you're constantly getting that erratic volatility that as an investor, sometimes you may not want to stomach. Now, if you're younger and you're doing, again, I'm not an advisor, nor will I say I am, but if you're doing some creative things with your advisors on the stock market and you're able to do things where you have a period of time to invest, absolutely. Obviously we're all doing that. But from a standpoint of looking at what's really consistent right now, what's showing growth, what's giving investors the opportunity to see expansion of their growth and their returns, real estate always has been fantastic. And so it's just a matter of where your tolerance level is, what excites you as far as what you want to get into, what type of returns you want to make, whether you want to make cash flow type returns and go to the mailbox every quarter and get a check in the mail, or if you want to be involved in a development project where you can make some larger size returns, but it takes a little bit more time. It really depends on what your appetite is and what you're really interested in as far as investing in real estate. But given today's conditions, given what we're seeing in the market, there is definite risk with inflation and with supply chain and with the market, different markets across the country, the labor market, that's what I was trying to reach out. Costs are definitely going up. But if you're getting into the right markets with the right sponsors, there's still amazing opportunity to do well in real estate right now. And that's kind of how I look at real estate through our lens and our business to make sure we're kind of looking at those markets that are prevalent to growth. We can go to the next slide. So some things you want to think about when you're investing in real estate, obviously the first thing is, can I invest in real estate given the types of real estate that John's talking about? And that's a great question, because on some of the private placement type investments, there's certain criteria you have to meet in order to be able to invest in a project. The Securities and Exchange Commission is the regulatory branch of giving out those types of requirements. But you have to meet what's called an accredited investor status or accredited investor position. And so you can look online for that. It's pretty straightforward. It usually dictates it by net worth or salary or income that you generate. And if you meet the criteria and you're an accredited investor, that opens the door for you to invest on private placement, different types of projects that the public doesn't necessarily have access to because of the fact that they don't meet that accredited investor status. Now, Robert Kiyosaki, who I'm a big fan of, again, I'm not soliciting for Robert, but everybody's read, I hope, Rich Dad Poor Dad. If you haven't, definitely grab the Rich Dad Poor Dad book. Robert is a very successful real estate investor. But when he started, he wasn't an accredited investor. So the book goes through the barriers that Robert had to really overcome in order to be involved in being an accredited investor and be able to invest with his rich dad and his friend to be able to participate. But it still gives you an opportunity if you're not an accredited investor and you considered a sophisticated or a qualified investor, you can invest in things that are open to the public. There are some platform investments like crowdfunding that does open the door to non-accredited investors. So before you get started and you jump on this, see where you kind of sit on the totem pole or the tiers on how you could invest. The second thing I would say is jump to the markets that you're interested in. And what I mean by that is look at the markets that you see things like population growth, demographics that show medium income or mean income at levels that show that it's growing or it has a wealth-based type market. Markets that show demand for businesses that are coming in. Other things we like to look at is conservatively fiscal markets that have good weather and have good quality of life. So we love the East Coast. We love markets like Atlanta. We like markets like Charlotte. We like markets like Washington, D.C. I could tell you more anytime if you want to reach out and talk to me about why I like those markets. And I'm not, again, an advisor or soliciting for those markets, but we like those markets because of what I just stated. Population's growing. They have strong income bases. I live here in Washington, D.C. Amazon HQ2 is in its second year of 10 of growth. It is just seeing massive growth, which is going to add to the need for housing. So when you look at those things, take a look at what is really the prime variables in those markets, including regulation. And so that may be another thing you look at. What the state tax income considerations are. So these are all the things you need to consider when you're looking at your market. The next thing is, hey, I know where I want to invest. I know that I can invest. What do I want to invest in? Do I want to invest in something that's, again, paying me cash flow every quarter? Or is it going to be a long-term capital gains, higher yield type investment? That's what you have to do and sit down. And you may want to have a professional. You may want to go out and grab a registered investment advisor or sit down with your certified financial planner if you have one and say, hey, look, I want to get into investing. I want to get into private placement or REITs. What are some of the things that I need to think about as I look at my nest egg of capital and investment dollars to put towards that as far as a percentage? And those advisors can sit down with you and give you some really good insights and give you some good feedback to see what's best suited for you, given what you want to invest in. So I would say that's probably number three. The fourth thing is, who do I want to invest with? Who wants to get my money? So now I want to not only go into the markets, I not only want to find the asset classes and the types of investments, but who are some of the businesses out there? And you can do that in a number of ways, a multitude of ways to find different folks. You can go on Google, you can go on LinkedIn, you can look for folks and really target those businesses that meet your criteria. After you find those businesses, then you put on what I used to call in the Navy your intelligence hat, and you start really picking them apart, really looking at their track record, looking at what kind of fees they charge for your money. How are they going to pay out returns? What are the things that you need to understand if you're going to invest in their projects? I can get into more detail, and please reach out to me anytime, because there is a very long standard list that I use as a pilot. You all know, pilots know, we have a checklist for everything, but it's very important because in my role and in my business, I'm going to be working with my investors, who are the ones that are going to be directly sourcing their capital into our projects that are partnered together with those businesses that we're partnering with. So I need to obviously have a good understanding of this, as well as if I want to invest personally and direct source my money into these projects. So you need to look at these sponsors. You need to look at their track records. Make sure you don't catch any red flags. Make sure from a business perspective, they meet the criteria of a company you want to work with. And then the fun starts. Then you start looking at their deals. Then you start looking at their projects. You start looking at the numbers. You start crunching the data. And, if there's folks out there that like to do that, great. If not, definitely look in and bringing in someone on your team that can help you with that, because that is definitely the most important part once you get through the initial criteria. You don't want to start looking at deals as number one, because that might not be the type of project or the asset class or the location or the sponsor you want to work with. So that's why I mentioned going through the tiers before you start looking at the deals. And when you're looking at the deals, you want to also make sure you look at things of how the legal documents are set up. How do these companies structure their taxes? How are you going to have to be able to report how you're earning investment returns to your CPA or your accountant to make sure that you're capturing that properly? So those are the big things. I'm going to take a 2-second pause because I want Mark and Marche also to share if they have anything else they want me to expound on, or if there's any questions. Mark, you're very familiar to what I'm talking about. Please jump in and let me know if I'm missing something.
Yeah, absolutely. We did have a question come in, and before we go on that question, I did want to say, so if you haven't gathered already, there's many types of, many different subsections of real estate, right? And it's always kind of the funny thing when someone says, hey, I want to get into real estate investing. What do you think? Right. And it's almost like asking someone like, hey, I want to buy a boat. Which boat should I buy? It's like, well, do you want a boat with an engine, a boat with a paddle? Do you want to go fishing? Do you want to go yachting? Like, we can go any number of directions here. So if you start getting some education on a particular topic and you get a not great feeling, it could be that subset of real estate. It doesn't mean real estate is not right for you, right? So that's just number one. Now, on the tax side of things, someone did ask, what are some of the tax benefits with going with real estate syndication? Are there any additional tax benefits going through, some of the big projects that you're going through versus just buying a house and renting it out?
Let me jump on. Yeah, that was a question for me.
Yeah.
Yeah, I mean, so the biggest challenge if you're going to actually go out and be active is, you're going to be doing it day to day. So if you're a business owner, or you have a W-2 job, or you're running other businesses and you don't have the time, or you don't have the resources to hire somebody to do that, that's where syndication really comes in, because you can be passively investing in an opportunity in syndication, but you're not there day to day dealing with the headaches of a tenant or the headaches of contractors or permitting. So that's one of the biggest things. I'd say one of the cons, because I'm going to always mention the pros and cons, the biggest con would probably be the fact that you don't have direct control sometimes. You're not making the big decisions. You're not, hey, we were going to make this a multifamily apartment development. Well, now we're going to turn it into student housing because we couldn't get the permit through, or something like that. So that's a hypothetical example. But it's really a matter of how involved a person wants to be, actively or passively. The active side, the sponsors have to go out and do everything. They got to go out and get the bank loans. They got to go out and get the permits. They got to go out and guarantee these bank loans. Whereas a passive syndicator, whether you're direct source or through a company like us, you're going to be just part of the equation, and be able to be just involved in that segment or that portion of the project. You still want to have eyes on the other stuff. Absolutely. Right. But at the same time, you're not directly involved or responsible for those things.
Yeah. Well, and then someone also asked it, as the money is coming back to you, is there a way to roll money into another project? And because I think most people are used to that 1031 exchange.
Absolutely.
Right? And is there something similar to that with going with a real estate syndication?
There is. So first and foremost, if you really want to try your best to avoid, the pain of taxes, think about a self-directed IRA, because those are really good vehicles to help not avoid taxes, but really grow that inside of the fund and use it as as a retirement vehicle. You mentioned 1031s. 1031s are purely active. So you have to own something, you have to be the sponsor, or be the owner of the property. When you completely liquidate that asset, you have to take your investment and your gain and move that into something as like investment. Whereas if you invest passively, you can take advantage of the 2016 Job Act investment vehicle, which is called an opportunity zone, which is really neat. And I won't go into it too much, but an opportunity zone allows you to take the gain and a portion of the gain and defer it into an investment opportunity, just like I'm talking about, a larger scale investment opportunity that's in an opportunity zone, and it allows you to defer that gain into that investment. So that's very exciting and very unique in the fact that you don't have to take your investment capital, you don't have to take all of your profits, you keep your investment that you put into the initial project, or whatever it is, your business, you're selling a stock, whatever it is, you take that initial investment to that, you take the gain, and then you could take 5, 10, 15, 100% of that gain and roll it into an opportunity zone.
Yeah.
So that's one of the advantages of passive investment and utilizing something passively in an inside of an opportunity zone.
Now, I will also add in here that there are other tax strategies you can dive into, right? There's other tax strategies that are complementary to this. That is really where a CPA gets involved. We did do Advice did do a webinar with Aaron Schaub. He's a pilot and CPA. In the beginning of this webinar, I don't know if anyone else caught that, where John said his CPA and now one of his best friends. A good CPA becomes your best friend pretty quickly, right? When they start pairing up tax strategies, that's one of those like, hey, drinks on me, buddy. Right. They become a real close partner pretty quickly. So in the spirit of just educating yourself in real estate, it is also very important to make sure that a CPA is actively involved in what you're researching, and they have some input as well as to, hey, if you do this, you can also do this, right? And kind of build on.
It's a great point, Mark. I alluded to it earlier briefly, and again, I'm going to give Robert kudos, but any book will tell you, if you get into investing in real estate, you want to have a good team. You want to have that accountant, you want to have that broker or registered investment advisor, you want to have a good partner that can handle certain aspects of the business or the side of the business that you may not be comfortable with or familiar with. There's a list of different people that you want to go out to that you definitely want to at least think about having on the team to be able to navigate through this, because it does get complex, and to try to do it on your own is a challenge. It can be done, it's just a challenge. So that's a great point. And again, it's really your appetite of how you want to do it. If you want to take your money and put it into the market inside of a real estate investment trust, that's fine. If you want to invest under syndication, that's fine. You mentioned some other options besides an opportunity zone. There's Delaware statutory trusts, DSTs. So there's definitely other things out there that you could take advantage from with your taxes. Absolutely.
Yeah. Perfect.
Any other questions or anything we want to hit, Mark, before we continue on?
There was one that came in, but I think it'll probably be best suited at the end of the webinar.
Great, appreciate it. We'll keep going. So I mentioned before, when you get involved in the syndication, you're going to be part of what's called the capital stack of the project. And the capital stack really is, hey, this is the money that's needed in order for us to do what we want to do. And so when you're going through these projects, when you're reviewing and analyzing deals, you want to understand how the capital stack is put together. And so the top of the capital stack, batting first in baseball, however you want to look at it, is typically going to be your senior debt or your senior lender, who's typically going to be a bank, either a regional bank, a local area bank, that comes in and is going to fund between, I would say, 50 to 75% of that capital stack or money that's needed to execute the project. We call that LTC, or loan to cost. Hey, it's a $10 million project. I need bank funding. I'm going to set it up at 75%. So the bank's going to bring in 7.5 million. I need to go out now and look for the other 2.5 million through the equity market. And so that's going to be your second and or third tier of the capital stack. is when your sponsor is going to go out and going to try to raise institutional equity and or general equity. Institutional equity, an example would be a private equity firm, an insurance company, a REIT that actually is going to have a collection of investors that are public, but it's going to be under the security of that PE firm or that group. So you're going to be one of thousands that is going to be part potentially of that specific opportunity, and that is built into the capital stack for the sponsor. The last piece typically is your general equity, and that's where a syndication company would come in, like ourselves, or you would be part of as a direct source investor, is you're going to be part of the you're going to be part of the general equity. And that really is where you get involved in private placement, or if you're doing it on a platform like crowdfunding, you'll be in that portion of the stack. And so just like the banks at the top and the general equity is typically at the bottom, reverse that when it comes to the returns. The bank's typically going to get that interest rate, anywhere from, let's say, in good times, previously to rate hikes, 2.5%, 3%, or up to maybe 4.5% to 5%. That preferred equity piece may get anywhere between 7 to 10 or 12%. And the guy at the bottom or gal at the bottom is part of the general equity is going to get the best returns, 12 to 18 to 20% returns for their money. Now you say to yourself, well, why is that the case? Well, the bank's going to have the least amount of risk. So the least amount of risk is going to get the lowest amount of return, right? Bank's going to have first deed position, or they're going to have ownership of the property. The sponsor's typically going to sign on recourse, which is a guarantee that says, hey, I'm guaranteeing this debt to 7.5 million. And oh, by the way, if the property doesn't get you the 7.5 million, or I can't get you the 7.5 million, we're going to liquidate the other members of the equity stack to get you back. So that's where the risk comes in. And I'm kind of jumping ahead, but the sponsor is going to sign on recourse. They're going to be personally guaranteeing that debt. So however that debt gets paid back, that sponsor is going to have to pay that debt. And what the bank's going to do in turn is take ownership if they have to, and have a non-liquidated asset in play to help recompense some of that debt. The second tiered preferred equity piece is going to have a little bit of potential collateral, maybe, maybe not, but they're willing to take a second piece behind the debt in order to get those 7 to, let's say, 12% returns. The general equity is really not going to be collateralizing anything at all. They're typically coming in as an uncollateralized, non-secured piece of money that comes into this, and in turn is willing to waive the fact that they could lose all of their money, but they're not participating in recourse potentially. They're not getting a lien position. So at the end of the day, they're going to see the lion's share of the returns. So the smallest piece of money is going to get the largest type of returns traditionally and typically on these projects. And that's something to think about. These sponsors have to go out and they have to find this money. When they get their debt, they still have to go out and raise capital either through their network, their friends and family, go on and find private investors, a company like us. So those amounts can range 6, 7, or 8 figures. And that's where they need that assistance with general equity, and where they'll typically go out and try to raise that capital through private equity. Okay. So again, yeah, I just mentioned this, and Marche, thanks for putting it on. Those are just some of the ways that after the bank is going to look to potentially commit, the sponsors have to go out and find different venues of raising that remaining capital to get them whole for that 100% capital stack. And we can go to the next slide. So yeah, how do you start investing? Again, we kind of alluded to this a bit, go through that, kind of tiered approach where you decide whether or not, A, can I qualify as a private or a public? Hey, where do I want to invest? What are the type of asset classes and the types of returns I want to get based on the return structure, my taxes, however you want to look at that. And again, we could dig into that more. The next is, who are the sponsors? Let's look at some of these specific sponsors. Why do I want to invest with them? What are some of the things they bring to the table? What's their track record? Are they willing to share information when I ask for it? Am I able to go down and visit them and walk some of their projects, which again is the fun stuff? And then you start looking at your deals. Then you really start getting into the meat of the projects. The last thing I would add too is, hey, how do I get my money back? It's great I'm investing in these projects, but what's the exit strategies? How do I get out of these deals? Well, my response to you is, don't just have one exit strategy. Have about 3 to 5. Why? Well, you could get into something called COVID, or you can get into something called inflation, or we could see a recession. And you want to be able to understand that the sponsor has multiple ways of exiting an investment for you. If the sponsor gets back to you and says, hey, Bill, this is the only way we're going to be able to exit this project, that's an issue. Because if it doesn't go as planned, that's where you start getting into some serious risk. You could lose money and nobody's happy at that point. So again, talk to your team, make sure you're comfortable. I would say hypothetically, some of the things we do is we have our investors look at our deals, see some of the things we've done before, so they have an idea of how this works. And that's what you should expect from the sponsors. The sponsor should be willing to share with you previous investments they've done or projects. Hey, I projected to earn blah, 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 blah from my investors, and here's how we did it. And here's the delta, and here's why. And you as an investor should be pulling on all those strings and asking questions. Hey, why did you charge a 4% fee? I'm seeing sponsors out there that charge 2.5% fee. Hey, why did you do this versus that? These are the things that you're going to start asking yourself. And like I said, build a checklist, put your thoughts down, pen to paper, go online. And there's great guys out there I know personally that have written articles on how to look at deals. Matter of fact, I use their techniques when I look at projects. Mark and Josh can attest to that. A lot of people have done this before. My most important and famous slogan in the Navy was, don't recreate the wheel. If there's a wheel, take it, make it yours, and then use it. Okay. There's going to be times that you're going to have to do it a certain way, but there's people that have done this before, have had a lot of success, and learn from them, jump on their coattails, get a mentor, learn from them, because these guys and gals are doing it. They've had success, and there's nothing better than give back and share experiences like I'm hoping to do with you today.
Perfect.
Well,
Now,
I'm gonna.
I think that's it. Wow.
And I did want to touch on that question, because so for someone wanting to get started, right? I had someone who asked, like, hey, if I'm not an accredited investor yet, but I have a sizable inheritance coming, are there any ways to get around that threshold of, say, hey, I don't have $1 million net worth, but I do have $500,000 coming to me cash, next year?
Well, let's not use the words get around, Mark. No.
Oh yeah, no, not get around. Sorry.
No, I'm just joking with you, man. From a compliance standpoint, because again, we're all very much in line with what the law says. There are opportunities that are open to non-accredited investors. In the SEC world, they use different types of registered or unregistered securities. So one of the most popular is the Form D 506, and the Form D 506 has 2 types of securities. And again, talk to a securities attorney, but from my experiences, a 506B is open to non-accredited investors. So if you go and you start looking for private placements that have the 506B symbol next to them, you can invest in those. There is some criteria that the sponsor does have to meet, or a company like I have to ensure. And the SEC doesn't line those out very well like they do for an accredited investor. But if you are able to work with sponsors that have 506Bs, those are the types of investments you can invest in if you meet that sponsors kind of compliance and what they need to meet. Now, the problem is 506Bs are not advertised by law. So they're not generally advertised. You won't see them typically on an open source platform, but they are out there. And again, that's where you build those relationships individually with sponsors and folks that are doing these things like us. Now, if you do make it to the accredited investor status, you can participate both in 506Bs and 506Cs. And the Cs are really only for accredited investors. And that's where, you have to meet the criteria that the SEC puts out. So hopefully that answers the question.
Yeah.
There are also other SEC forms that are out there that are crowd raising. I think it's, Mark, correct me if I'm wrong, you may know, Form A, 501. Those are general crowdfunding, registered or unregistered securities. Again, do a little research on that, and you can really get some more information that would be pertinent to your specific situation.
Yeah, and if anyone does have very specific questions, because we have, we've had John on our podcast, we've had a few other real estate people, and we're always happy to connect people with a good resource, right? I mean, we don't make private placements, but we do at least get the education rolling for people. So that is good to keep in mind. Now, another question that did come in too is if there is a change in a project, right? If someone goes into a project and they're changing the style, or the project just gets canceled.
Sure.
What happens to the funds if a project is canceled or just gets downgraded a lot?
Yeah, and listen, that's a great question. It's not a one size fits all. You have to look at the opportunity. You have to pull up the operating agreements, before you either sign them or you're reviewing those to potentially invest. If you're doing it through syndication, there'll be a private placement memorandum and package that you'll get that covers all the legalities. But that would be stipulated in those documents so that each individual investor understands, okay, here are all the risks. And oh, by the way, if this happens, what happens to my money? And the answer, to be quite honest, could be you lose it, or you lose a portion of it, or hey, we have to liquidate the asset. It may sit in escrow for 2 to 3 years, but we're going to fight our darndest to get you back your money. And that's in writing. So again, it's not a one size fits all. It just really depends on the project, but it's a great question to ask the sponsor if it's not clearly delineated in the documents. Absolutely.
Yeah. Yeah. And again, this kind of goes back to building that team and, not telling you what to do with your money because it's a free country, but most people don't go all or nothing on stuff like this. It usually is a very calculated move with a portion, getting your feet wet, getting comfortable, and building that team around you.
Yeah, that's another person to have on your team, maybe a business attorney that can review these documents for you. It does cost some money, but it's definitely worth an investment if you're getting involved in this the first time, and another good person to have on your team.
Mm-hmm. Mm-hmm. And again, just one more plug there. We did have the pilot CPA. He had some good insight just on how you can be more tax savvy, and he's always open to have a follow-up conversation if needed.
Yeah, I agree, Mark. And I'd say, again, I'm not trying to sway or give advice or whatever. I'd say, you hit the nail on the head. The top three that I would say would be your CPA, probably a registered investment advisor or CFP that can walk you through what this all entails. And if your CFP, your certified financial planner, is from Morgan Stanley or Raymond James, they may not know. So that's why it's good to go for someone that's specialized in that area, like a registered investment advisor, an RIA, because they can get into more of that language and speak to it. And then the third I would say is making sure you have a good attorney, someone that can help you walk through the process and go through those documents, especially, when it gets into that lawyer language and it doesn't really resonate well, or it doesn't make sense. That's definitely a plus.
Now, we did have one more follow-up question come in about what happens if a project doesn't get canceled, but it turns out it's underfunded. Is there ever
Yeah, that's a great question. And again, something you want to look for on the operating agreement. There'll be a section in the operating agreement called capital contributions. And so it'll be broken up into, initial contributions, additional contributions. And so what you want to look for in the operating agreement is you want to look under the additional contribution section. I could tell you from our standpoint, we call them capital calls, but it's really an additional contribution that is required when the sponsor says, oops, I need more money. And, I put in my operating agreement that I can come to the equity investors for more money. Then you have to come in for additional capital. Now, if you look at that and say, I don't like this, talk to the sponsor. So our sponsors and the folks we work with have it as an option. And so in that situation, there may be the need for more money, but they won't come to us. Or if they do come to us, it would be optional. And we would have the opportunity to potentially come in And not getting too much into the semantics or the weeds, but if you're coming in for more money, guess what? You have more ownership, which means you should have a bigger piece of the pie and get a better return. But if you're like, hey, I don't want to have to be bringing in more money if this guy or gal on the sponsor side undercuts or undershoots, I would definitely want language in there that says that you are not required to bring in additional capital, that it's either the sponsor or it's their responsibility to find that additional capital, not you.
Well, very good. We have run out of time today, and I want to say thank you so much, both to Mark and John, for lending your experience and your thoughts in this very informative, exciting topic. So thank you so much for being here. We want to thank the organizations that have also made it possible for our presenters to be here as well. So to our people who have attended, look for an email soon with a link to the replay of this event, and you're welcome to share that with friends and family. And again, if you have any questions and we weren't able to get to them, go ahead and leave those in the comment box, and we will, in the chat box, and we will make sure someone reaches out to you to address that. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone that we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon. Bye, everyone.
Thanks, Marche. Thanks,
you.
Mark.